Hey, this is Jack from Alpha Charts with a state of the market video. Today is December 10th, 2022. Before we get started, this video is for informational purposes only. These are not recommendations to buy, sell, or hold any stock or security. Now, I may hold positions in some of the equities mentioned. Know your time frame and risk tolerance. Again, if you haven't done so yet, please like and subscribe to my video down below. To my channel, my YouTube channel. Thank you. If you have, I appreciate it. If you haven't, please do it right now. Again, it helps me out, keeps me doing these videos, gives me motivation to do more of this type of information. All right. Thank you. All right. Find me on Twitter at AlphaCharts365. SPX. We had rejection at the trend line 4 times. I think this is the trend line now that everyone has on their chart. We've had it for a while now, and have been watching it. What is it going to do here? Above the 200-day, which was a little bit different than here, about the same as here. It got rejected pretty hard, ugly. Underneath the 9-day, underneath the 23-day, underneath a declining 200-day, which was going to try to flatten out soon, right? If you could have, if price could have stayed above it, right, it would have started to flatten out, but nope, still declining. In this 50-day, the lone 50-day going higher. Obviously, it may, price may come down here, and we don't know if this will be a support-ish area as it meets the 50-day, wherever that happens to be. And then we'll see what happens. But the weight of the market, I think, will be way more than the 50-day can handle. And we'll see if the VWAP down here, 3590-ish, if that is what gets hit next. And that VWAP, if just so we can all be clear on what that is the VWAP from the 2018 low, Christmas Eve. Okay. So that is my view on SPX with, again, the weight of the market pushing down on it. There's, lower highs. You see each major lower high, right? Then you see the lower lows right here. The question is, and we don't know yet. We'll know if we take out this VWAP. Does this lower low here get taken out? Like it's been taken out every time since the top in, we'll call it December, January. Right. So we don't know that yet, but we'll find out soon enough. How far down does it go? Does it go all the way down here? It doesn't have to, right? It doesn't have to. We'll see though if it does. We got 3 more weeks or so left in December, and then it's a new year and new problems, right? All right, let's keep going though. RSP. So on the week, again, it was a rough week. On the week, SPX was down 3.37, RSP 3.30. So about the same. Okay. So again, we're looking for divergences. There is none to be seen. So let's just go with that. But what do we see the difference here? If you see the 200 price still above the 200-day on the RSP, the equal weighted, which is kind of interesting, right? We'll see if that continues to hold. Again, it was an ugly day, and it does look like the way the market's going to be pushing this down as well. We'll see if it acts better than the SPX as things are pushing down. That'll give us a lot of breadth information if there's a divergence to be seen. So far there is not, right? So far there is not, but we'll keep our eyes on that. The Qs remain to be super duper weak. This is let's do the regular Qs first. Regular Qs, similar enough trend line, right? Didn't even come up to tag it, rolled over. Your 50 days literally right below it, 5 points, a couple percent. So it's right there. And we'll see if this trend line now will hold. And you say, well, what's that trend line? Let's go to the weekly chart, right? That trend line is going to, why am I not on log? There we go. Thank you. There's a log. That trend line is from the 2010 lows, and it has held, since, for over a decade. This is a decade-long trend line. So it has some merit, hit multiple times throughout. And now we're going to find out, right? We're going to find out soon enough, potentially, if this 250-ish area which is right where the trend line is going to hold right underneath that. This 235 to 240-ish area is another potential area of support. If the trend line doesn't hold, if we get down there, right? No guarantees of anything, but so far not looking good. We'll see if the weakness continues, but decline again, the weight of the market, right? Now on the week, down 3.59, equal weighted, was down 2.84. So much better. That's divergence kind of stuff that we're looking for. It's not below the 23-day on the equal weighted. So you could definitely see how the mega caps are definitely getting hit harder than, especially in the technology areas. The larger cap names are being hit harder, and people are probably at some level buying smaller cap technology. It may not be hot and heavy, but it's more than what they're doing with the large cap or mega cap. They're more selling than buying in that. That's how I read this. All right, IWM. We have this head and shoulders toppy-ish pattern. We don't know if it's going to confirm or not, but we do have this trend line, which is now broken. It's sitting at the 50-day already. So you're looking at IWM being the weakest of the bunch. So that is definitely a risk off type of move, right? If IWM is leading to the downside, it's already to the 50-day. So it's leading to the downside. So break that 50-day, and I think this 166 level, or somewhere in here, 170 to 166, maybe even 160, 4.5 to 170, that range will get retested. I think there's not much going on to hold it up, maybe 175-ish, but we'll see. If this, if there's any more weakness in the market, declining 200-day, I wish it was something different, but it's all about the same. All right, IWO, very similar, trend line broke. It's already below the 50-day again. So there's your growth names, small cap growth, and it's weaker than regular small cap. That again, you don't want to see, right? Weight of the market. Now it's below every key moving average. Everything's crossing lower. All the positive buildup we've had for, since May, basically, of maybe this was the bottom. Again, it still could be, it's in the range, but it's still going to need more time, if nothing else. Still needs more time. And mid caps were holding up the best, and they are still above a 200-day, but just barely. So we'll see on the pullback if they have a shallower pullback. Now again, you have this kind of little loop here, right before the little double bottom, and maybe it needs some more symmetry, right? And so it needs, maybe it's just doing this, and then it's doing something like that, right? So you got a very symmetrical look to it. That's a possibility, right? Kind of like a two-headed double bottom, right? But that's a possibility, right? So let's keep watching it and see. We don't want to go too far, over our skis bearish, but mid caps are looking better than the others in general, still holding up better. Down, let's see on the week. Down 4% on the week, so got hit a little bit harder on the week, but again, above the 200-day still, so we like that. All right, so there we go. There was all the indexes. Not a pretty look to them. I mean, there's still, slivers of hope in there, but I think the weight of the market's keeping them pushed lower. Let's look at what the sector ETFs, the important ones to me, are. We talked about this rising, not rising wedge, I'm sorry, this volatility. Increase of volatility in a megaphone type pattern that was coming on, and we could even kind of do this now. I think that makes maybe more sense. And definitely a lot of volatility, and right at the 200-day for the financials. And again, maybe like the mid caps, maybe it's, you have the little blip here, maybe it needs to, the 50-day, and then it kind of holds in that area. I guess that would be my bullish outcome. The bearish would be to retest these lows, right? And these lows are super duper important. We're going back years and years and years. 2008 precedents, right? 2007, right back here. 2018, 2020, and then it's held here. Do we test it again? I don't know. Maybe not. It's around what, $30, $31, somewhere around there. And that'd be obviously, the more times that level is tested, the more likely it is to break. So hopefully we're getting just that little, extra symmetrical look to it. And it comes down to this range, maybe 32, and then it holds, makes a higher low, and then maybe we get a breakout. That's the bullish scenario. Bearish scenario would be coming all the way down to this area, and then it holds. And then if this breaks, that's a completely different type of bearish scenario. So we don't want to see that happen. But XLF, breaking down, nothing more to say about that. SMH, right? Maybe the most important. Semiconductors hold up better than most, right? I mean, so you got this kind of area here, and you got this area here, right? And you have this kind of flaggish look to it, and it literally kind of holding up a little bit. So this inverse head and shoulders ish pattern is still in play. If you think about it, price is still above its 9-day EMA. So that's pretty impressive. SMH. I mean, if you want a positive tilt onto this market, right now it's semiconductors, right? That's the most bullish thing we can find out there, is that it hasn't broken down. It's right. Moving averages are starting to kind of clump up, even though it's still below a declining 200-day. It's been holding up better than most, and so we have to definitely pay attention to that. Just see, 200 days is roughly February 24th. So yeah, so I mean, it's into the end of the year. We'll clean up this data. If it can hold up, that's that'd be really impressive, right? So definitely a potential bullish outcome on SMH, which really like that. You see the declining volume and some nice green sticks there again. All right, so SMH looks good. That's a positive. Transports, they look pretty bad. Again, you have the trend line, like we've seen, very strong declining 200-day moving average, and you have lower highs and lower lows along the way. If transports lose the 50-day, which they're sitting basically on it at this point, you may get 66.50-ish and then 63-ish, 63.50. But again, very, very poor look on the transports, equal weighted. And let's look at housing. On the housing front, okay. So surprisingly, housing is holding up better than most, right? The sector that everyone's saying housing is going to crash because of interest rates and there's no supply and blah 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 blah. Whatever their reasoning is, I don't even know all the reasons, or if I'm even saying the right reasons. But everyone's saying that the housing market's got to crash again, right? And the builders are saying, hey, we're not doing so bad. Maybe because of the low supply that our build, we're being bought up. And so people are buying the builders. XHB, not only, remember, XHB is not just builders, it's also the associated companies around the builders, right? That supply the builders. So not too shabby, right? February 24th, we said. So yeah, so another one, as we clean up the end of, go through December and clean up this data, if price can stay in this general range, things were going to get interesting, right? There's a gap right there that kind of holding, right? To the top, you have this general area right there. So we'll just kind of extend that, right? Something like that. And that gets interesting, right? If it can stay in this range as the rest of the market corrects. Maybe you have, semiconductors and home builders leading us out of here. We have to pay attention to that. So, but, so as ETFs, right, as indicators, kind of a mixed bag. Semiconductors, home builders looking good, right? Now, again, a breakdown here changes my mind on this immediately. But transports and financials, questionable. So mixed bag on the ETFs. let's look at the internals. Just go ahead and just clear this stuff off. And go to line. There we go, VIX. So we've had a falling VIX, and now we have a rising VIX, right? Still low. Still not like, oh my God, you had a big spike this week for a couple of days, and maybe it's moving higher now, right? But still in a range, a trading range, I think. But so overall, not terrible look to it. We'll see where it ends, how far it goes. But as of right now, things are looking okay with the VIX. Credit spreads. So that's interesting, right? If the market's going to fall apart, wouldn't credit spreads be spiking? And we didn't see that. That's interesting, right? We're still seeing this consolidation in this kind of triangle-ish area. Again, eventually it's going to have to come out of it. We'll see which way. And we don't even know if this triangle is even a valid look, right? It could just keep going sideways beyond the triangle. But as of right now, it's holding, so we'll go with it. But we're not seeing a big spike up. So that's a positive on the internal part, right? Let's look at the put-call ratio. Yeah, very spiky here. That is the whipsaw of the market incarnate right there, right? That's what we see right there. So the whipsaw of the market, people are getting bullish, people are getting bearish, and we'll see what happens. You had this almost right here, the spike right in November that got to, that basically started a nice bull run, which we like to see. I didn't realize it got there. What was the high there? 1.399. That's close enough. I didn't realize it touched. But it did. Maybe they revised some data too. That could be, because I didn't think it touched. Anyway, we should probably put a marking there. I'll do that later. Anyway, so that looks good. Whipsaw the market. That's what we're seeing right here. Back and forth, the choppiness. And then let's look at the percent of stocks above the 50-day moving average for a breadth indicator. And you can see breadth deteriorated this week, but still isn't horrible, but is declining. So pay attention to that, of course. I like to look at bond yields. 10-year started to spike up a little bit, nothing crazy. We'll see if this is the start of a bigger move or just a part of the chop on the way down to this maybe this 3.162-ish level. We'll find out for that. And dollar is, I guess, higher. Not that much higher, though. Yeah, on the week, was the dollar up or down? Dollar was up just slightly on the week. Again, falling wedge right here on the dollar. I wouldn't be shocked if this breaks out. If we do see the breakout on the dollar, that would be a headwind for equities. And I think that would definitely be more of a risk-off scenario. So watch that dollar, right? And just going back to TNX, we had this movement down, even though we're in a rising rate environment. Since November, rates have been falling. And what does that mean? That means that maybe there's people going into risk-off status. If we do see rates move higher, as much as that is a headwind for stocks, at least they're not going into a risk off. And you can see TLT, which is the 20-year treasury. Since November, people were going treasuries, and maybe on Friday we saw people starting to come out of treasuries. We'll see if that starts and continues. So the goal would be, really not big moves in here. But okay, we're in this range. Let's stay in this range, right? That would be the ultimate goal, is to stay in a range. And that would be probably beneficial for stocks, if not, a slide lower. But we may not see that big slide lower until the Fed decides to pivot, which could be years away. All right. Anyway, enough of macro talk. I don't, no one's here for macro talk. But watch the dollar. I think the dollar falling wedge is definitely something to watch, and that's a big deal. So there you go. So in the end, let us sum everything up. And what are we seeing? We're seeing indexes which look pretty rough and look like they want lower. We're seeing IWO, which is pretty which I'm really watching closely, breaking down ahead of IWM. which I'm not a fan of. We're seeing the internals not spiking, so that's, I think, a positive. And we're seeing some of these sector ETFs so far holding up. Now, next week they could all fall apart, right? Or they could all improve. But as of right now, there's a mixed signal right there. So my guess would be next week is probably a drift lower, maybe not capitulatory look lower. And maybe there's your inverse head and shoulders here. Maybe it's making an inverse head and shoulders here, right? On the SPX. Can we do this? Sure, we can do whatever we want to, right? We're drawing the lines. But maybe it's making the right shoulder of an inverse head and shoulder, and we're closer to the bottom than we think. And maybe, it needs some more time and a drift. Again, like I said, a drift lower. But maybe things are crapping to the first quarter of next year. And then you know what? As we enter a recession officially, maybe that's the best time to buy stocks, because it usually is. So don't get all doom and gloom yet, right? We're not there yet. I think there is a bullish scenario that is always available to us. I think that in the short term, going into this week, I think a drift lower makes sense. And then probably into the start of next year as well, but we'll do it week by week, of course. And then hey, that would be pretty awesome if we can see this area kind of hold, right? Make the inverse head and shoulders, and maybe by second half next year or spring or something like that, we can officially call bottom. Anyway, we're not there yet. Let's keep watching this stuff. I think that there is a longer term bullish scenario that we can hang our hat on. Short term, be careful this week. If you're long stocks, be careful. Take care, everybody. Tomorrow's stocks to watch. If there's anything holding up, working out. There were some semiconductors I really liked, some other stuff. So let's check it out tomorrow. Find me on Twitter at AlphaCharts365. Post all my links there as well. Take care. Bye-bye.